Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. In today's video, I'm going to be explaining and exploring the best ways to maximize Roth contributions to an IRA or 401k if you're self-employed. And don't worry, if you're not self-employed, there's going to be some amazing tips in this video, straight from a tax attorney, that you can implement and use to maximize your Roth contributions. I'm going to focus on IRAs, SEP, simples, 401ks. And again, even if you're not self-employed, these are tips that you can use if you have access to a 401k at work, or you just want to take advantage of the Roth IRA contribution, which anyone could do, whether you're self-employed or not. So give me, 25, 30 minutes, and I will tell you everything you need to know to maximize Roth contributions if you're self-employed or not. So let's start at the beginning. What's a Roth IRA? Okay, and I'm going to start with the IRA world, go through Roth IRAs, talk about SEPs and simples, because guess what? Thanks to Secure Act 2.0, you can now do Roth contributions in a SEP IRA and a simple IRA. Bet you didn't know that, right? Well, if you've been watching my videos, reading my blogs, listening to my podcast, you probably do. But for everyone else, here you go. 400 or so pages of the $1.7 trillion omnibus bill that was passed in the end of December 2022. So 90 or so provisions involving retirement accounts, which is known now as Secure Act 2.0. I'm going to just focus on a few of the key ones, specifically the SEP IRA and the simple IRA, which now has Roth options, which never had before. So Roth IRA, what's a Roth IRA? Created in 1997 by Senator Roth of Delaware. The idea of the Roth IRA was to give folks another option who want to save for retirement. So instead of doing pre-tax contributions like you did in a traditional IRA, you get a tax deduction, but once you reach 59 and a half, pay tax on what you pull out. Senator Roth wanted to offer a slightly different option. And the way that option worked was the contributions were after tax, which was very positive to the Treasury because there was no tax deduction, which is something they really appreciate because it doesn't reduce taxable income. And then this is the catch. So once you're over 59 and a half and the Roth has been open at least 5 years, it's all tax-free, right? So that's been the big play with Roth IRAs, is that, hey, if you could trust the process, if you have patience, and you could persevere not getting an immediate tax deduction, then you can take advantage and generate tax-free gains in the future, which for me is obviously a huge, massive tax planning opportunity. I wrote a book, God We Trust and Roth We Prosper, about 6 or 7 years ago, really on the Roth IRA and the Roth 401k. I'm a really big proponent of Roths. All my retirement accounts are Roth. I do Roth IRAs, backdoor Roth IRAs. I do all my 401k contributions through the IRA Financial 401k plan through Roth. I just don't want to deal with taxes when I'm 59 and a half. So that's been my play. Yeah, my accountant, around this time of year, usually around March, April, we get into a 5-minute or so debate about, hey, wouldn't that $20,000 or so in that 401k, that deduction would kind of feel kind of nice around now. And I'm like, yeah, I get you. Deduction, let's say, catches you anywhere from 20 to 37%, depending on your tax bracket. So if you put in, $20,000 in a 401k, $4,000 or $5,000 deduction, that's meaningful. But my game is, hey, I think I can do a lot better over the long term with investments, and I'm a pretty patient guy. I hope I'm not going to have to tap in to those funds. So ultimately, when I'm over 59 and a half, I'll just be able to pull those funds without tax. And I believe I'm never going to stop working. I love what I do. So I hope to have income up until the day I die. So I feel like my income level will never go down to like kind of just Social Security and some investments. I'll always, hopefully, God willing, be able to work, do stuff that I love. So I think my income will be, decent, maybe not at the highest tax bracket, but somewhere in the middle. So having that income tax-free distribution as a viable option to me, is super attractive. So that's why people want to go Roth, right? That's why we're doing this video. How do you maximize your Roth strategies if you're self-employed? So number one, Roth IRA. 2023, you can put away $6,500, $7,500 if you're over 50. For 2022, which you still have time, right? It's only March 1st today. You have until April 15th to make contributions for 2022 in your Roth IRA of $6,000 or $7,000 if you're over the age of 50. Now, for 2023, if you make less than $153,000 and you're single or married, filed jointly, $228,000, you generally do Roth IRA contributions. If you make more than the 153 or 228, you're generally capped out. However, the backdoor Roth IRA, which you've heard me talk about many, many, many times, is the solution and workaround. And since 2010, there's no longer any income limitations for Roth conversions, meaning anyone could do a Roth conversion. Prior to 2010, if you had income above a certain income threshold, you were not able to do a Roth conversion. But government realized that conversions are a great way to get people to pay tax upfront earlier than they would have otherwise. So they want to encourage people to do so. In fact, in 2009, 2010, when tax revenues were way depressed because of the financial crisis, they incentivized people to take conversions by actually paying the tax over 2 years. Now, that's been passed, no longer valid, but still, they're encouraging people to do conversions. The government loves Roths. Believe it or not, they love Roths. Even though, if you're thinking logically, it makes no sense, right? Because in 20, 30, 40, 50 years, you're going to have all these Roth accounts just pulling money out tax-free and not paying tax on their distribution as those accounts grow in value, right? But governments only generally look 4 to 8 years down the road, right? That's the election cycle. They don't really care what happens in 20, 30, or 40 years. So someone else's problem. So the first strategy, Roth IRA. So even if you make $1 billion a year, you max out your work 401k at Apple, Tesla, IRA Financial, you can still do a Roth IRA. Again, even if you make $1 gazillion a year, how? Through the backdoor Roth IRA. You make an after-tax contribution of $6,000 or $6,500, $23,000, $7,500 if you're over 50, and then immediately convert those funds to Roth. One caveat: if you have other pre-tax funds floating around from prior years, the amount you convert, there's a pro rata formula that will not allow you to put everything in Roth and will actually tax a percentage of the backdoor fund. So that's only if you have other pre-tax IRA funds floating around. It could be at any institution. So let's say in 2016, you had an IRA of $2,000 you put in. Now it's worth $5,000 and you want to do a backdoor Roth IRA of $5,000. Only 50% of that $5,000 will be Roth. The rest be taxable. So just as an FYI, just something to be aware of if you want to do the backdoor Roth IRA. Let's move to the SEP IRA world. SEP IRA world is a pure profit sharing plan. You need to have a business to do a SEP. If you're not self-employed, you don't have a business, you're just rich or self-employed, rich or just retired, you can't do a SEP. Okay, SEP's a pure profit sharing plan. 23, you can put up to $66,000 away. Before 2023, those funds were always pre-tax. The way you get to your maximum amount is you take your compensation. If you're a Schedule C, 20% of your Schedule C up to $66K. The 22 number is $61K. And if you're a W-2, C or S Corp, it's 25% of your W-2 up to $66K. So if you make $100,000 in 2023, you're an S Corp, $100,000 W-2, not in the Corp, but W-2, you put away 25% of 100. If that was Schedule C, sole proprietor, single member LLC, 20% of 100. And before 23, that had to be pre-tax. The company would get a tax deduction and the funds would go into the SEP IRA pre-tax. Starting in 23, you can do Roth, meaning that 20 or 25% could now be Roth. The downside, you don't get the tax deduction. Okay, your business does not get the tax deduction. The upside is it's in Roth. So long as you're over 59.5, that account's been open 5 years, bang, it's all tax-free. Okay, so that's the play, right? And at the end, I'll kind of summarize everything, put it all together, and explain, kind of give you some tips if you should go Roth or not. But that's the play with the SEP. You can make SEP IRA contributions up until the business files its return, including extensions. Okay. There's no catch up if you're over 50, but now those funds can be Roth. Prior to 23, they could only be pre-tax. So that's another strategy now, the SEP IRA Roth, that did not exist before 2023. Simple IRA. Simple IRA is, again, set up by a business, whether it's a sole proprietor or a small business. Simple IRA is generally a poor man's or poor lady's 401k plan. Why? The maximum you can put away in 23 is $15,500. To catch up with $3,500 if you are over 50. And then the employer has generally a profit sharing matching component, a little bit less than a 401k, but there's also a matching responsibility that goes along with simple. Prior to 23, only pre-tax. Starting in 2023, those contributions can be in Roth, the $15,500 and the $3,500 catch up. Pretty good option, right? It's another opportunity now, another strategy that Roth self-employed folks could use. Prior to 23, it was just a Roth IRA in the IRA world because SEPs and Simples could not do Roths. Now, starting in 2023, Roth Simples, Roth SEPs are viable options. The downside, you don't get the tax deduction. The upside, all those funds can grow without tax, so long as you're over the age of 59 and a half and the Roth's been open 5 years, no tax on distributions. No required minimum distributions for Roth IRAs, SEP or simple Roths as well. Okay, they are part of your estate, but there's no RMDs. Let's move into the 401k world now. If you work at a business like Apple or Tesla, employee deferrals, the $22,500 or the $30,000 if you're over 50, that can be pre-tax or can be Roth. That was the rules before the Secure Act as well. So the $22,500, which is a dollar contribution, plus, or if you're over 50, the $30,000, that could be pre-tax or Roth or some match or pro rata allocation, whatever you want to choose. So that's always been there before. Profit sharing, okay, and I'll start with the 401k world and then move to the solo world. But let's start at regular 401ks, multiple employee 401k plans. There's generally about three components. There's the employee deferral, the $22,500 or $30,000. There's a safe harbor match, which is generally 3 to 5% employer match. Prior to 23, that only can be in pre-tax. Now there's an option starting in 24, not this year, but starting in 24. That the match could be in Roth. Okay, so the Roth option never existed. Now you have the opportunity to do matching in Roth. That was never the case prior to 2023. The match is a percentage of, and that's not necessarily, you can also do a match that's not safe harbor. Okay, so there's employee deferral, there's also an employer match, there's a profit sharing and safe harbor. Those are basically the four components of a 401k. The match, sorry, it does start in 2023. The employer match before 23 cannot be Roth, and now it can be Roth. The Roth is generally a percentage of the amount you contribute. Okay, so a lot of people on the safe harbor match now have the option to do pre-tax or Roth, but that brings into questions which still are not answered from an employer standpoint. Is that Roth tax deductible? It isn't a pre-tax contribution. You're still giving money to the employer. You would think it's tax deductible, but if it's Roth after tax, it's tax deductible. We'll see. There's answers both ways. We're still waiting for further guidance. Profit sharing is not the match, right? The profit sharing is either up to 20%, just like the SEP IRA, or 25%. SEP IRA, that is Roth option. In the 401k, it's not. It's still pre-tax. Okay. The match, which is a percentage of the deferral, the percentage that the employee puts away, that could be pre-tax or Roth. The profit sharing, which is a percentage of their salary, that is still pre-tax. Okay. So in the 401k world, if you work for Apple or Tesla, employee deferrals can be pre-tax or Roth. If the company doesn't match, it can be pre-tax or Roth. They're going to generally have to offer the Roth option. The profit sharing, which most large companies do not do, like Apple's and Tesla's, Fortune 500 companies, they'll generally just give you the employee deferral option and the match. Those now have pre-tax and Roth options. Profit sharing generally do not have Roth options. SEP IRAs do, not 401ks. And we'll get into the Solo K in a minute to talk about kind of how the profit sharing works and how maybe the matching could take over from the profit sharing. So that's the 401k world. The same rules generally apply to 403bs and 457s, although the match generally would only apply to 401ks. The employee deferrals, 403bs and 457, which are tax-exempt government plans, generally also have Roth options. Let's move to the Solo K. What's a Solo K? That's a plan for someone who's self-employed. Someone has no full-time employees other than the owners, their spouses. Full-time employees, 1,000 hours or 3 consecutive years, 500 hours. Secure Act 2.0, starting in 24, is going to make it 2 consecutive years of 500 hours. So if you have a Solo K, there's basically, in the past, there's generally been 2 ways to make contributions, right? There's employee deferrals, same as a regular 401k, 22,500 or 30,000 if you're over 50. And then there's the profit sharing, which is the 20% or 25%. When you add them all together, the most you can put away is 66,000 or 73,500 if you're over 50. The profit sharing is pre-tax, but you can convert it to Roth, right? So for example, Solo K, Schedule C, you make 100K, under 50. You can do 22,500 pre-tax or Roth, and then the 20% profit sharing is pre-tax, but then you can convert it to Roth. Now, technically, Solo Ks can also do matching, right? Like our plan docs allow for matching. No one did matching because the profit sharing was a bigger number. But the difference in 23 versus 22 is matching could be Roth. So technically, we could build in your plan where 100% of your deferrals, if you put away 20,000, let's say 100% can be matched in Roth. It still may not get you to the 66 or 73.5, but if you don't want to do the conversion from the profit sharing, that's potentially an option, which we never have used. We've never really used matching strategies in a Solo K just because there's always been the employee deferral profit sharing, which would give you a bigger number because the profit sharing is 20 or 25% of your comp. The matching is a percentage of the actual elective deferral contribution, which is lower than your salary in most cases. So the profit sharing in conjunction with the employee deferral is always going to give you a bigger number than the match. But now the match can be Roth, and if you're a Roth lover, you may want to do match versus profit sharing. But here's the tipping point. The mega backdoor Roth 401k just kind of solves all your problems, okay? The mega backdoor Roth 401k is the ultimate strategy, and I saved it for last because it's the best. It's the best ultimate Roth strategy for someone who's self-employed. What is it? It's basically a way to go up to the 415 limit of 66,000 or 73,500 all in Roth, okay? Meaning dollar for dollar, just like an employee deferral, but instead of stopping at 22,500 or 30,000 if you're over 50, you can go all the way up to 66 or 73,500 if you are over 50. What you do is I suggest kind of having two bank accounts. Let's say you're just going to max out, you make 100K, you want to go 66 in Roth, you're under 50, you put 66 into your after-tax Solo K bank account, and literally an hour later, a minute later, a day later, you move it to the Roth account. Since you're going after-tax to Roth, there's no tax. You don't have any of the pro rata rules like you did on the pre-tax IRAs and the backdoor Roth IRA, so it's cleaner. And you can leave the Roth 401k in the plan. You can actually roll it to a Roth IRA even if you're under the age of 59 and a half without a trigger event. So it's a monster, massive strategy. It's the ultimate, the Super Bowl of Roth strategies. You can't get better than this. It's impossible. This is the best. And it's dollar for dollar. So you don't need to make $1 million to put 66 or 73.5 in. You can basically do it if you're making like 75 or 80K because you have to still take out self-employment tax, Social Security, and FICA. It's about 15 or so percent. But the net of that can go right into the mega backdoor. So you can go basically 10 times more than a backdoor Roth IRA. In fact, you can do a backdoor Roth 401k and a backdoor Roth IRA. So that's pretty neat. You can get to it quicker than a SEP IRA Roth. You can get to it quicker than the SEP a simple IRA Roth, you can get to it quicker than doing employee deferrals Roth and a conversion by profit sharing. You can get there quicker than doing employee deferrals and the Roth match. It's the best way. Fortunately, folks just don't know about it. Why do I focus on solo Ks and the mega backdoor instead of just a regular 401k? Because basically, if you have a regular 401k plan at Tesla or Apple, most times they're not going to be able to offer the mega backdoor. Why? Because the mega backdoor is its own category of contribution, and it's subject to its own plan testing rules. So generally, who's going to do the mega backdoor? It's the highly comps, the executives. And if you're not getting enough rank and file, maybe low earner employees, the plan will fail the top heavy test. It's possible they can pass it. It's just super rare. So, there's Wall Street Journal articles and other articles suggesting that, 20 to 25% of plans have the option. That may be right, but it's probably less than a few percent that actually could pass the top heavy test and the ACP test, which is the annual contribution percentage test, and pass the ERISA test. Because generally not enough in rank and file employees end up doing the mega backdoor, and it's too much of the highly comped, which tip the plan and make it top heavy and fails ERISA. But if you're a solo 401k plan, self-employed, you're not subject to ERISA. So you're not subject to top heavy testing, ACP, ADP, and the like. Why? Because you have no non-owner employees. So there's nothing for ERISA to protect. It's just you and other owners or their spouses. So ERISA doesn't need to come in and protect you guys because you can protect yourself. Whereas if you have non-owner employees, ERISA applies and needs to protect rank and file employees to make sure they're getting proper participation opportunities and obviously benefits as per the plan rules. So let's just summarize everything, and then I'll get to, at the end, why you'd want to go Roth or not. So what are your options? Now, if you're self-employed or not, you can still do a Roth IRA, backdoor Roth IRA if you make more than 153 or 228 if you're married, filed jointly. Okay, so that's number one. You can also, if you have access to a 401k at work, most 401ks now offer Roth employee deferral options. So you can ask for that option. You go up to $22,500 or $30,000 if you're over 50 in Roth. You could also now, if you're getting a match from your employer, ask for the match being Roth. Most plans are now going to have to offer you that option. So that's another potential sum of funds that could go Roth. But if you're self-employed or a small business, your options are enlarged. You can now do a SEP IRA Roth, $66,000. Yes, it's a profit sharing plan of 20%, 25% if you're a W-2, but you now have that option. Some people love SEPs. Now you can go Roth. Simple IRA, some people just are simple IRA fans. Why? Because they have a bunch of employees and they have segregated accounts. It's less administration than a 401k. Why? Because the IRA custodian, i.e. IRA Financial, will file the 5498, whereas if you have a 401k, the employer files the 5500. Some folks just are simple people. And now you can do the 15.5 and the 3500 in Roth. So that's a nice little wrinkle, game changer for some folks. So, okay, obviously, employee deferrals can be pre-tax or Roth. Profit sharing is Roth. Profit sharing, is pre-tax, but you can convert to Roth. And now, thanks to Secure Act 2.0, the match can be in Roth. But ultimately, if you want to maximize Roth, you just got to go mega backdoor, right? You can mix and match, right? You can do 22,500 employee deferral and the rest in mega backdoor Roth. Or you can just do all mega backdoor Roth. Or you can do 22,500 pre-tax and mega backdoor Roth for the rest. You can mix and match, okay? You just can't go above the 66 or the 73,500. How about this? Let's say you work at Apple and you max out 22,500 or 30,000 if you're over 50, pre-tax or Roth, and you have a different business. Let's say you sell shoes on eBay or you, do consulting work. You can set up a solo 401k for that business and do the difference between, let's say, 30 and 73,500, which is 43.5, all in Roth under the mega backdoor, so long as you have enough income, right? So there's tons of amazing Roth strategies out there. You just got to work with the experts, right? Obviously, I'm not very objective. I think we're the best. I've written 2 books on the Solo K. I've written 8 books on self-directed retirement accounts. We have 23,000 clients. I think we're the best. I know we are. So obviously, if you work with the best, you're going to get the best advice, right? I always use the example of like lawyers. I was a lawyer for 9 years. I worked with lots of lawyers at big law firms. Some went to Harvard, some went to Ivy League, some just went to regular old schools. Not all lawyers are the same. There's good lawyers, there's bad lawyers, there's mediocre lawyers, just like doctors and dentists, landscapers, contractors, right? Not everyone's great. Just because someone's a lawyer and they went to law school or they have an IRA company doesn't mean they're good. Okay, so I believe we're the best. I think that's why we have been successful. Is we care about our clients and want to make sure our clients get the most detailed and accurate information. So if you set up a solo K from us, from IRA Financial, you can know and guarantee that you're going to be getting access to our tax professionals, and you're going to get best consultation to put you in the best type of retirement strategy, whether it's backdoor Roth IRA, mega backdoor Roth 401k. Hey, we may look at your situation and say, hey, you may want to just go SEP Roth, right? You make $1 million a year, you're under 50, SEP Roth's easy, just do it, right? So it's all facts and circumstances. Not all cases or examples are the same. And that's why I really keep focusing on work with the best. And I'll be honest, if I speak to someone and then they are like, yeah, I set up this solo K or this IRA 4 years ago with X company or Y company, I'm always like, well, why didn't you use us? And they're like, yeah, I don't know. I just went online and I guess I didn't see you and I just chose this company, or my friend used this company, and I take it personally. I do, just because I know we're the best and we can give you the best service. And we get a lot of takeover plans and IRAs where people call in and just like, hey, I use this other company. No one talks to me. I can't get good advice. They just tell me, go talk to a lawyer. I may have this UBIT issue, or no one ever told me about the backdoor 401k. I've been doing pre-tax and conversions. I read your blog or listened to your video, your podcast, watched your video, and hey, help me out. And we love doing that because that's what we're all about. So I take it personally. I do. So I understand there's some good companies out there. Nothing against my competitors. I like them a lot, but I really just think we're the best. And I know we're the best. So if you didn't use us, that's cool. You can still call us or chat us or email us. We'll answer your question. Seriously. I'll never say no to someone. If someone sends me an email with a question or a chat or comment, I'll always respond. I may not spend 20 minutes on the phone with them, but they'll get an answer. Maybe short and sweet, but they'll get the answer. But that's it. So should you go Roth, right? Let me get to that. Sorry, I'm going to give you my lawyer answer. There's no right or wrong answer, right? Don't you hate when lawyers do that? You pay them to write a memo or an email, give you an answer, and they don't. They give you both sides of the story and then basically give you some blurb at the end that it's based on facts and circumstances, and there's no right answer. It's all great. Thanks for the $10,000 memo. That's kind of the Roth IRA conversion, right? There's a lot of factors that are at play to determine whether it's good or bad for you. And you may not know when you're doing it. You may think it's the right strategy when you're doing it, but 15, 20, 30 years down the road, it doesn't end up being. So what I like to do is just kind of break down what are some of the tips as a tax lawyer that I think about, that I tell my clients to consider before doing a conversion. First, age, right? Obviously, the younger you are, the more power a Roth conversion has, more years it can grow. That's pretty simple. Two, what do you think your tax rate will be? What do you think your income level should be? Let me rephrase that. What do you think your income level will be when you are at 59 and a half, or in your 60s or 70s, when you're going to be pulling those funds out? Think you're going to be low? You're going to be retired, just on Social Security, basic income? Or you're going to be working like me and never stopping talking about self-directed IRAs and 401ks? If you think you're going to have a high tax rate, then conversions make sense, right? Because you're sheltering those funds from tax. If you think you're going to have a low income, then conversion maybe doesn't make as much sense, because who cares if you pay 10, 15% on the income? It's small versus 30 or 35% if you're a higher income earner. Third, know yourself, right? Are you patient? If you're not, and you feel like if that money's there, you're going to tap into it to go buy yourself a car or deal with something else, don't do the Roth. Because the only time the Roth really pays for itself and becomes a massive win is if you can wait till you're 59 and a half and the Roth conversion is over 5 years mature. So you got to do the 59.5 and the 5. That's the key. Okay, so you got to be patient. Obviously, you got to trust your investment skills, right? If you're just a really bad investor, like a mush, whatever you touch turns to not gold, the opposite. Maybe don't do a Roth, right? Because the problem with doing a Roth is, let's say you're converting 100K of cash today, and you think you're a great investor, but it turns out you're really not. And then 100K is, never really reaches 100K again, right? It kind of dips and dips and dips, and maybe it hovers around 50 or 70. So now you pay tax at 100K and you only got 50 or 70K to show for it. That's not a win, right? You would have been better just staying pre-tax. Are you going to hit a home run, right? Is this a home run investment, right? Hey, this investment, it's the sure thing. A sure thing as, LeBron James scoring 30 points a game, or another Pat Mahomes going to the Super Bowl, right? Is it a sure thing, right? No one knows for sure, but would you bet on it? If you feel strongly, then obviously converting those funds and having those funds grow in a Roth, makes a lot of sense. People have been burned, right? We got burned on cryptos, I got burned on some other investments as well. I haven't sold them, so you don't lose until you sell. But obviously, at this point, I would have been better, not doing a conversion if I did one, because the amount I invested in, the value today is lower than what I invested in, let's say, last year. So it's a timing game, right? No one knows when you're going to need the money and what those values will be, right? If you took the distribution in 21 versus 22, you won. If you had to take it in 22, you probably lost because of the values of the underlying assets. What else would I think about? Who are you going to leave the money to, right? You're going to leave it to a spouse, kids. How important is it for them to get those funds without tax, right? That could be just another important gift that you're going to provide, another legacy where you're like, hey, here's all this money and it's tax free. Now that means a lot to some people. The last thing I'm going to say is tax rates. No one knows, right? So that's why I left it to last. A lot of people say, well, tax rates are going to be higher. There's inflation. We're spending money like crazy. There's going to be more wars. China's going to invade Taiwan in the next year or 2 years, and we're going to have to print more money, and tax rates are going to have to go up to pay for all this stuff. I don't know. Yeah, maybe. I don't know. But it's hard to bet on that because no one knows, right? And if tax rates do go up, they may come down 5 years after that. So it's hard to bet on that. I like to focus on not things you can control, like your investments, what you're investing in, what's your strategy, where your tax rate's going to be. You kind of know yourself. Are you the kind of person that you think is going to work till you die, or are you not? You're happy just being in a cabin, living very simply on Social Security and some extra passive income, where your tax rate will be relatively low. Because even if tax rates go up, they're generally going to go for the rich, right? The people making 500-600K plus, not the folks making 50-60K. So who knows? And then ultimately, I always leave this to last, the horror story, worst case scenario where the government changes the rules on us and basically say, sorry, you can't have Roths anymore. You got to just take everything out now and spend it. I give this example many times. Social Security before 1981 was not taxable, believe it or not. You got Social Security, right? It's your money. You paid it into the system. Why should you pay tax on it? That was the belief. That's the way Social Security worked before 1981. You got those funds without tax. Now it's taxable, right? So you're paying tax on the tax you already paid on the income you got. It's like a quadruple tax. Not fair, but what are you going to do? So that's obviously worst case scenario, that the government changes the rules on us. That's why some folks that I know really well are rather just take the deduction up front, do the pre-tax IRA, because they just don't trust the government. I have a little bit more faith because folks in government want to get reelected. So they're generally not going to mess around with Social Security or people's retirement accounts. It's just not a good way of getting reelected. Yes, Biden and the Democrats did try to play around a little bit with the Build Back Better, but they backed off very quickly once people started fighting back a little bit and expressing how unhappy they were with changes in some of the retirement provisions, and they pulled those things super quickly. So not as worried about that. But again, there's no right or wrong, right? It could work for you, it could work for me, it may not work for her, it may not work for him. You got to know yourself. Focus on the things you can control, not on what the government may do in 20 years or what tax rates will be. That's kind of it. So just wanted to, again, recap everything. This video definitely did focus on self-employed Roth strategies, but even if you're not self-employed, the backdoor Roth IRA is a great opportunity. It's 6,500 or 6,000 last year, 7,000 if you're over 50 last year, 7,500 if you're over 50 this year, just extra cash in your Roth, right? Do that for 15, 20 years. You're going to have six figures, mid six figures tax-free when you're at age of retirement, just for putting in 5, 6K a year. And that's on top, hopefully, of Roth 401ks you can put in at your full-time job. If you're self-employed, even if you have a full-time job, you can do now SEP Roth, Simple Roth, or do the Solo Roth and just hit the maximum with the mega backdoor and just kind of say, you know what, forget it. I don't really care about SEP Roth, Simple Roth. I'm just gonna go mega backdoor. That's my thing, right? Just go right to the ultimate prize. Skip all the foreplay. Just go right to the prize, and that's the mega backdoor. It's the best. It's the ultimate. More people should be doing it. That's why I do these videos, just educate people that not all plans have them, but if you can get into a plan that has it, like our plan, IRA Financial, it's just ultimate Roth strategy, and every Roth lover should be doing them if you can, if you're self-employed. So thanks to everyone that's watching. We hope Bitstamp in March. We're going to be launching it. If you're a client of IRA Financial on the crypto platform, you'll be hearing from us very soon. And we're super excited about our new partnership with Bitstamp. We also just announced a new partnership with Realty Mogul. We're going to be doing a webinar with them in early March, talking about some exciting opportunities, folks that want to get access to some really exclusive deals, some fractional real estate opportunities, REITs. Could do it through a partnership with Realty Mogul. So that's super exciting and kind of fun. So otherwise, a great time to be self-employed, right? You can control your future. You can work from home. You can get Obamacare, so you don't have to worry about healthcare, right? I remember, 10 or so years ago, 15 years or so ago, maybe, I was looking to start a business with a friend, just dabble on the side and potentially even leave law and do it. And one of the things that stopped us was healthcare. We're like, oh man, we need healthcare. And it's really tough and expensive to get healthcare on your own if you had a small business. Well, now you can do it. Okay. And ultimately, you have better retirement options if you're self-employed, right? The mega backdoor Roth is generally not available if you work at Apple or Google. It is if you have your own business. Whether you want to max out SEP Roths, Solo 401k Roths, the ability to go employee deferral, match and Roth plus profit sharing, and the mega backdoor, you're just not going to have it a big Fortune 500 company, and you're going to be able to do on your own, just setting up a self-directed Solo K plus. You can do alternative assets, right? If you have a 401k with Tesla or Apple, you're going to be stock buying ETFs and mutual funds. Whereas if you have a Solo K self-directed, you can do ETFs, mutual funds, but you can also do alts like real estate or private businesses, cryptos, gold, tax liens, I-bonds, even T-bills, right? I'm actually doing a podcast next week on how to use an IRA 401k to buy T-bills and I-bonds. Getting a lot of information. Obviously, I-bonds are longer duration, 30 years. You can sell them earlier, but T-bills are under a year and getting pretty good returns. And the only caveat is you need the IRA LLC or a Solo K to do it if you want to do it through a self-directed account. But super easy. You as the trustee or the manager of the LLC can open the account on Treasury Direct, bang, and buy those. If you're buying the bills, you'll buy them at auction online, and obviously the I-bonds, you can buy them online as well. You're capped in how much you could spend in an I-bond, but not in T-bills. So with interest rates going up, those are some nice ways to diversify, get some safe returns. Obviously, it's backed by the U.S. government, so it's pretty much as safe as you're going to be able to get. So that's it. I hope you guys enjoyed today's video. Thanks for watching. Don't forget to subscribe. It's a great channel. We drop 3 videos and a YouTube live every week, but 3 podcasts as well. You can obviously watch the podcast on our YouTube channel. Leave a comment. I do my best to get back to all of you. Relatively short order. And it's free, right? So you might as well take advantage of it. Otherwise, have a great day, and I'll see everyone again next week. Ciao. Take care.